Let's start. Let's move to the new topic. Let's move to the new topic. Marks by very important M&A and business valuations. It will have a link with the security valuation, and approximately we expect, although I have given you a one separate chapter called EVA. EVA is a part of business valuation. M&A is a separate chapter in your book, and business valuation is a separate chapter. I have taken is combined because it's very difficult to do valuation of M&A with by segregating. Approximately, I think 16 to 20% weightage holds this chapter. Maybe most of you would assume it to be simpler. You are able to do it, that's fine. Weightage wise, if I take security valuation, bond valuation, mutual fund in this chapter, if your luck is good enough, might have 40 to 45% weightage of the paper. Then comes forex, derivatives, that becomes one combo. Then becomes a portfolio, and the newly added capital budgeting, that becomes one combo, and then the smaller. But obvious, yes, something new would happen this time. So weightage wise is important. It's a simpler chapter. You cannot tend to make a mistake. I'll be slightly faster in this. We're covering it. And M&A and business valuation. Some new additions have happened, which I'll take it at appropriate time, because they have given a theory, but I think going forward there would be very high chance they'll be asking you the practicals on the same. So I'll tell you, startup finance already you had, but they have given a startup financing. For example, if there's negative cash flows, how do you do the valuations of a firm? Because this trend what we are in is basically, even if you don't have income, leave about the income, even if you are burning your cash, still the valuation stands. That would be a different version altogether. Now coming to it, I have given you a handout. Let's come to it. I'll be slightly faster in this, being the easier stuff. It might be written as M&A and corporate valuation. Earlier the topic was corporate, now it has become business valuation. You can accordingly shift. Although few additions have happened, rest everything we have kept same, nothing has changed, so it becomes a business valuation. Even M&A cannot be done without the valuation. So generally when you start off with is, first of the questions which remains in the important in the exam is the exchange ratios which comes out. On the exchange ratios you have the questions, swap ratio you call it as, although this is not how the deals happen. This is something a kind of a post-mortem analysis, but in your case he gives you question on that. A swap ratio or exchange ratio. Three popular ratios on which he will ask you deal will be on market price, based on the EPS, based on the book value per share. Then there is a some fourth one which I have not written here, which we'll see slightly at the end. Every time you'll have a target by acquired company, there is certain way of reading it. How do we read it out? I have taken small examples. I think 2 examples I would have taken on the next page. First example I have taken is, you can just quickly go through it. I know 99% of you would know it, but still formality wise I have to cover it up. Flow becomes easier. A stands for acquired, T stands for target, net income both of them given, share outstanding given, EPS given, share price given. Case 1 I have taken when the deal is based on the EPS, earning per share. If the deal is based on the EPS, if there is no synergy, synergy is a benefit due to deal. If question specifies, it's okay. If question does not specify, you cannot take it out. If there is no synergy, deal happening on the basis of EPS, no party would gain or lose in the earnings term. The words are very clear, no party would gain or lose in the earnings term. Then why do deal happen? Deal happens because of the market value terms maybe. He'll ask you, calculate a swap ratio. Swap ratio would be, you will calculate the EPS, accordingly you will calculate. Then calculate the new shares to be issued. New shares would be equal to, once you calculate the swap ratio, it will be 5 by 4, 1.25 is to 1. Way of reading is its target divided by the acquired. Way of reading is, for every 1 share of the target, acquired would issue 1.25. And number wise you should be able to justify, because target is sacrificing 1 share of its own and getting the 1 share of the acquirer. So he is sacrificing 5 rupees, 4 rupees is getting into 1.25 into 4, justifies his numbers. The new shares issued would be the old outstanding shares of target into the exchange ratio, whatever number comes out. One point to remember is, let's suppose I am acquirer. A common mistake which generally we make is, let's suppose I am acquirer and you are a target company. I am acquiring your company based on the stock deal. It's a stock deal question. We'll cover something on the cash deals, which is somehow is seen in your exams now. Now let's suppose it's a stock deal. I am acquirer, your target. I was holding 10 lakh shares earlier. My number of shares with me will remain 10 lakh. Total company as a whole number of shares would increase. I'm saying it again. If I am a acquirer, let's suppose I am holding a 10 lakh share outstanding. My number of shares will remain 10 lakh. The new shares which are issued to you, the total capital, total number of equity shares of the acquirer will increase. But if I was a shareholder who was holding 10 lakh share in my hand, still there would be 10 lakh shares. I would be able to compare all the numbers and can come to know whether we are gaining or losing. So in this case, for example, when we calculate new shares to be issued, it comes 2 lakh 50. Acquirer had 10 lakh, issued 2 lakh 50. Total becomes 12 lakh 50,000 shares. Combined earning would be net income of both A and T. You'll combine, that's a 50 lakh. 50 lakh divide by the 12 lakh 50. It comes rupees 4. Now you can always compare this 4 and this 4. If there is no change, that means no party gaining or losing. Second important part is, when you look at this example, you cannot compare the target company because target company number of shares have changed. So you cannot compare. If he says compare on the EPS basis, we'll calculate something called equivalent EPS. Otherwise you cannot compare. In totality you can see that will come nil. That was based on the earning. Second example, when you go back home, you can quickly go through it because these questions have come ample number of time and still we see some part of it will repeat, no matter you love it or do not love. So do not be under the complexity that I can leave out this chapter because 16% to 20% weightage this chapter will hold. In this case, deal was based on MPS. The exchange ratio would be share prices 75 by 100. In this case, number of shares again will remain, that the old outstanding share into the swap ratio. The way of reading 0.75 is 0.75 means for every one share of a target company, acquirer will issue 0.75. Total number of shares, then you can calculate the new EPS. If you look at new EPS, it comes 4.35, and the old EPS of the acquirer you can compare is 4. It means 100% acquirer has gained in the earning term. Now target would have lost. In case you want to find the impact on earnings, then you can calculate new earning 10 lakh into 4.5 of acquirer. 4.5 into 1,50,000, I think, new shares of acquirer. Old earning was 40 lakh, old earning was 10 lakh, and this comes gain loss. Due to rounding off, it is not coming, otherwise gain of 1 would be loss of the second party. That's a general question which comes out. If doubt comes in, if by chance interviewer asks you, by chance you go for the interviews after your exams and then say, why does the deal happen if someone is losing on the earning term? Deal never happens on the earning term. Deal happens on the valuation, which you have been doing in the accountancy. Exactly same thing will do in different parameters. For example, idea announced that they will be raising some funds. For example, there is a board meeting on 27th, I think. There is a board meeting 27th. That means they will not say that you are coming in, this is our EPS, you come. They have a negative EPS anyhow. They will have some valuation parameter, maybe the subscriber base, maybe some other parameter, and accordingly the valuation is done. So there are n number of drivers, we call it as. In your institute has tried their level best to introduce that what are the drivers. For example, the hotel industry I speak about can have the number of rooms, or hospital number of beds. There are some different parameters. I have no clue that how they will be asked, because practically valuation takes different scenario. This valuation what you are doing here is a conventional as of now. If time permits, at the end I'll show you the different parameters how they can give you. In fact, one of the known parameters, EBITDA, they have started taking questions on that front in the exams. So this is only a swap ratios just to check your gain or loss, but somehow this becomes core part of this chapter. First question which I've taken is question number 3. I'll quickly take up the easier questions. I'll stop at some lengthier questions and the points which will trouble you. Although I know third question will not trouble you at all. Third question will not trouble you at all. But this is a benchmark question. I think 5 to 7 times this itself would have been asked in exam. The same question, maybe 6 to 8 marks. You cannot tend to lose out here. Verbally we'll discuss. I'll show you the format. If 8 marks comes, you make according to that format only. K Limited is considering acquiring N Limited. Following information is available. Company is available. Number of equity share, profit after tax, PAT, market value per share. Exchange of equity share for acquisition based on the current market value as above. That means it's a current market price swap ratio. it comes target is n 160 is to 200. It's basically 4 is to 5 0.8. That means for every one share he'll get 0.8 shares. Then there is no synergy advantage. Find the earning per share of this. He is directly asking EPS. You have to calculate swap ratio, new shares, combined earning, new EPS. Quickly calculate roughly. How much do we get? 5.416. Now, if you can compare 5.416, you can directly make out. If you look at the old earning of the K, if you look at the old earning of the K, it's 50 lakh divided by 10 lakh. How much it comes? 5. And he is getting what? 5.416. So when K is gaining, he would be losing. Second says find the exchange ratio so that shareholder of N would not be at loss. My recommendation would be, if it's a 2 marks question or a 4 marks question, show the proof also at the end, please. Generally, if it's a 8 marks question, it's a 4 and 4. So the proof, that means deal would be based on the EPS. And when the deal is based on the EPS, at the end you calculate the new earning, compare with the old earning, and then show it. There will be no gain or loss. You look at the answer. On fourth number, right. Way of reading slide is from your side, this to this. Basically, K limited, N limited. Here outstanding, PAT available 5 lakh, 15 lakh. Then you have a 200, 160, this EPS. New EPS swap ratio. First part was 5.42 or 5.416. If the deal happens in the ratio of the EPS, then shareholders of N would not be at loss. Swap ratio would be 1.2:1. That means for every one share, he has to issue 1.2 shares. New shares to be issued will be 3 lakh. Total share outstanding 13 lakh. New EPS 5. And then you can prove that impact on the earnings would be there. I hope there should be no challenge. Please calculating impact on the earnings. Earnings would be basically new shares are issued 13, new EPS is 5, 5 into the new shares 3 lakh, it's a 15 lakh. Old earning was also what? 15 lakh. I hope there is no doubt in that part. Now, like your CA foundation, you would have done financial statements in which you used to ask you trading account, profit and loss account and balance sheet. If you recall back your junior classes, maybe 11th class or 12th, whatever year you would have studied, what they'll give you is, they'll give you sometimes 6 adjustments, sometimes 8, sometimes 7. 5 of them would be common, only one would change. Exactly these type of questions have something same. Now the questions which I am covering will have one new adjustments, so our focus would be on that additional adjustment. I would like highlight that during your exam time, only read that adjustment and go, because in every time, in the recent trend also I have seen, your institute is trying to modify only one adjustment. Rest will say calculate EPS, calculate swap ratio, gain loss, etc. One he'll give you. So we are moving to question number 1. First question number 1. Now before I go forward, we were doing India Bulls Housing Finances dinner. Very good. Right is you. Just show you. You have to feel when you do financial management, insight should come. Greed is good. What is good? Greed. For example, you have a hunger for the marks, you have hunger for the money. When you invest, then only you can earn. Yesterday I was telling you, yesterday you were able to see only what? Only 2. Today you are able to see what? 3. See PP. PP is partly paid. And how much they asked for? 50. Let me click here. Think of a situation. One of my cousin called up. You cannot imagine how many shares he applied. Got how many shares? not 20%. It's a 100% return. The partly paid will take 2 minutes because you have to feel finance. Otherwise, you cannot learn the subject. Means subject would be very basic. Learn the formulas, do it. AandBull housing finance right issue. This was right issue, and if you that how much rupees they asked for, if I click anything here, let's suppose it tell you every data is available. It's not something I'm creating from my side. Total was 150, but you have to pay terms of payment. We paid 50 per share on application. Actually, this I used to feel very odd. When I did my accountancy long back, we used to have application money, then allotment. I think first call, used to feel nalayak what they teach, and in practical life, it's one-time payment. In the last 2-3 years, this thing has again come back. Application money, then they'll ask for the final call. Advantage is now it becomes so easy market. For example, if I applied for the partly paid, I'm getting 100% return. I sold off. There's no headache of even doing it. And what I'll do is I rather buy the fully paid maybe if I want practically. So this has become now, I think, the share capital. I think you would be doing the application money, then allotment, then first call, forfeiture, and I think forfeiture would also be coming, because if someone fails to make a payment, forfeiture will take place, and they'll enjoy the money like Suzlon. Although this is not I'm saying become a Suzlon, but something can happen. You can imagine this comes. I'll show you the price of India Bull also. AandBull, just for a minute, so that you know. AandBull housing finance also increased, but that increased by 9%. That also increased. So there has to be symmetry. Actually, why the price became 106, that you try to understand. 150 allotment price. Once you get that 150 paid, ultimately that will become what? Fully paid. If that becomes a fully paid, the price should have been what? 206. I hope you are getting my point. So that price 106 is reflecting, if anyone would have bought today, if he pays 100 rupees more, 100 he'll buy that, 100 he'll pay more, it'll become same as this only. So there has to be some, but basically those who applied for the right, they got 50 rupees extra. It was 50 rupees extra, or I can say 100%, because 50 was the money and 50 they got. That was the right issue. One more exercise I'll discuss with you at the end on the practical side, because you have to get the feel out of it. That was just a right issue because topic came yesterday. Let's come back to Rama and Krishna Limited. For you, marks is the greed as of now. You have to have hunger for it. Krishna and Rama Limited. Read the question carefully. We'll do it verbally. One point I'll tell you which has to be done with carefulness. Out of this, which is a acquirer company? Rama Limited. Target. Acquired target. Data is available. One important line he says, company Rama is acquiring company Krishna Limited, exchanging on 1-to-1 basis. 1-to basis means one share for one share. Let's compare the language with the fourth question once, please. Come back here. You do not flip over, or maybe you can see. Fourth question is line called using a share for share exchange. Now this line is not same as 1-to-1. The first one is exactly 1-to-1. This is share for share. Both have shares in common, but this is not one share for one share. So be careful in the language when the language comes differently. It says one basis, the exchange ratio is based on the market prices of the shares of the two companies. You are required to calculate. So swap ratio will become 1:1. Basically, Krishna Limited would be issued how many new shares? 2 lakhs. Total shares after the acquisition become 2 plus 4, 6 lakhs. What will be the EPS? So 17 lakh divided by 6 lakh. 2 point. No one will have a doubt in this. 2.83. Second party says, what is the change in EPS for shareholders? Now he's asking change in EPS because there is no basically there is no change in the number of shares outstanding before and after the issue. So we can compare the EPS. Old EPS of Rama Limited was 2.53. New EPS is coming what? 2.83. So there is a gain of 0.33. The old EPS of Krishna we can compare, sir. Yes, 2 lakh shares are base is same. 3.3, new is 2.83, is losing what? 0.67. If the doubt comes, sir, you said earnings loss of one would be same as the gain of second. It's basically the number of shares are not same. It's 2 lakh and 4 lakh. What I want you to check in this part is second. If I show you here, when we say impact on EPS, it's on slide number 5 I'm on. When I say impact on EPS, actually gain of one should be equal to the loss of the second. In this case, it is not same because Rama Limited has total number of shares as 4 lakh. When you multiply 4 lakh into 0.33, it should be equal to 0.67 into 2 lakh. And please always check in the exam, do not be in a hurry. In the earning term, if one party is gaining, second party has to lose, and that to be equivalent amount. That has to be equal amount. In this case, I never said the earnings per share would be same or would be gain loss same. It's a total earning would be same, which comes out. Third part he is asking is calculate what? Market value. He says P ratio remains same. Price earning ratio, even if it does not say, is one of the most important valuation multiple that remains same, we assume. So whenever he says P ratio remains same, basically you have to calculate new EPS into P ratio. It gives you what? Market price. Market price into share outstanding will give you the new market value, 37. Fourth point, he says, this is the point you can highlight. Fourth point, which you have to be careful on. Fourth point says, ascertain the profits accruing to the shareholder of both the companies. Now, since third point is talking about what parameter? Market value. Fourth point, when it is following, actually understand how the examiner makes a paper. For example, examiner makes a paper, he asks, calculate the new EPS, calculate the gain or loss in the EPS, calculate the market value, calculate the gain or loss. Now his mind is working in a symmetry. If third point was about gain or market value, the fourth point gain or loss would be in the market value term. I'm saying it again, please. There should be no doubt if I would ask you that fourth point would be gain or loss in the earning term or a market value term. The examiner, when he's setting a paper, any kind of passage, he'll say that calculate new EPS, calculate change in the EPS, calculate market value, calculate gain or loss. That means gain or loss he is talking about just a part before he has asked. It was a market value, fourth part would be following the third part. So this fourth part, a certain profits accruing will be gain or loss in which term? Market value term. Similarly, I have taken some more question. For example, in the fifth question, he says, fourth point as determine the market value of the merged company. And fifth point says calculate gain or loss to the two independent entities. That will be in the what value term? Market value term. So depending on the previous part, read the next part which comes out. So accordingly you can calculate. What we have to do is, once we calculate the market value post merger firm, that comes I think 237.72. Price came how much? 39.62. If price was 39.62, then you can calculate is 39.62 into 4 lakh new value of the Rama Limited minus 4 lakh into 35 old market value of the Rama Limited. Similarly, 39.62 into new market value of the Krishna minus 2 lakh into 35 the old market value of the Krishna Limited. Calculate the same. Both can gain in the market value term, yes, and that is the reason of the deal actually. If you ask me why the deals happens only for market values. Deal happens only for market values. 1848, 924. Done. Next is sixth question. 3 times they have touched in the exam now. Recently also came. Sixth question. Highlight the third point. Highlight the third point. A wants to acquire T Limited and has offered swap ratio of 1:2, 0.5 shares for every 1 share of T Limited. Following information is provided: A Limited and T Limited, they've given profit after tax, equity share, EPS, this. The number of equity shares to be issued by A to T. Swap ratio is what? 1:2. So you multiply target into 1/2. How many shares? 90,000. Total number of shares would be 6 lakh plus 90. 6 lakh 90,000. Second part he is asking is to calculate EPS. So EPS would be PAT. Combined PAT is how much? Combined PAT is 12 lakh, 21 lakh something. 21 lakh 60,000 divided by 6 lakh 90. 3.13. Now look at this word, equivalent earning per share. He is actually asking equivalent is, in the case of A, this 6 lakh share remains as it is. You can easily find the gain loss for that. Equivalent earning he is checking for is T Limited. Basically T Limited is sacrificing 2 shares and getting what? 1 share. So this 3.13 is equal to the earnings of 2 shares of the old. If I use this layman's language, so 3.13 represents, it is equal to the earning of 2 shares of the old company. So equivalent would be 3.13 into exchange ratio 1.565. 1.565. If you have to compare the EPS of target, you can compare this EPS and this EPS, which we'll see slightly short while from here. So equivalent earnings is only for the target because the number of shares are not same. So way of reading is 1.565 represents the earning equal to the 1 share earning of the old company. Basically because he was sacrificing 2 and getting 1 new. In 1 new he was getting 3.13. That comes out. Then what is the expected market price? That's an bread and butter for you. P multiple remains the same. Determine the market value of the merged firm. You can quickly check the answer. At least do the calculation please. Anything which troubles you can ask me, I'll stop. And wherever I know I have to be slightly slower, I'll get down. That basically this point was the important equivalent EPS. Quickly check it out please. Equivalent EPS, market value of the merged firm. This recently came, I think one point was new. Rest 5 were same. Question number 2, I think this came in this year exam. Number 2, it came in June 2009, 20 marks, Abhiman Abhishek. 20 marks that time used to come. Now they do not have 20 marks. I think now they are not even asking the 5 points, they are asking only first 3 somewhere. Abhiman Abhishek. I'll read out quickly. This time it did not come for 20 marks. I don't know how many marks. I think 8 or 10 it have come. This question, I think this came in this year exam. Question number 2. The following information relating to acquiring company Abhiman Limited and target company Abhishek Limited are available. Both companies are promoted by multinational company Trident. Promoter holding is 50% and 60% in Abhiman and Abhishek. That means Trident holds, promoter is holding 50% in Abhiman, 60% in Abhishek, and balance is held by, you can assume, public. That's called, actually that is called free float market cap. Free float market cap is the free float shares which are held other than, you can imagine, other than the promoters for the exam perspective, although there could be some plus minus, but from the exam perspective, whatever promoter is holding, as per the SEBI guidelines, promoter does not have the liberty to sell the share as and when he likes. Otherwise, they can, if they know some negativity, they can sell off and go away. So there are some creeping limits. They cannot do it so easily. So they do not trade their shares in the market. When you say I have bought some share, I sold some share, they're part of the free float. Free float is other than this. It means free float share or free float holding would be 50% in this case and 40% in this case. Then he says Abhiman and Abhishek Limited are given. Share capital 200 lakh, free reserves 800, paid up share capital 100. The free float market cap, free float basically this represents equal to 50% and this represents equal to 40%. P ratio 10 and 4 times. Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, weights are assigned to different parameters by the board of directors as follows. Its book value per share, actually, whether he mentions or not, BVPS, earning per share, market price per share. Basically says instead of doing the valuation or the swap ratio on one parameter, let me take 3 parameters and assign the weights. So basically what I need is, for acquirer and target company, I need book values of both the companies, I need earning per share of both the companies, and I need what? Market price of both the companies. What is the swap ratio based on the above weights? So my first target is to find 3 numbers for them. Let's put down the focus on the table. What data is available to us is, we have share capital, free reserve, paid up capital, free float, PE ratio, and what we need is book value per share, earning per share, and market price of 3 companies. I have availability of paid up 100. Do not flip over slides, please. Help me out, then you can look at the answer and I'll show you the answer together, don't worry. 200 lakh capital. Using this and this, can I calculate the share outstanding? You can help me with Abhiman, Abhishek, I'll tell you to do on your own. 200 lakh capital, 100 paid up value per share. How much will come? 2 lakh. You know what is book value per share? Book value is nothing but a shareholders fund. It's basically equity shareholders fund rather. Share capital plus reserves and surplus. Total book value is 1000 lakh. 1000 lakh divided by 2 lakh shares. We get book value per share. How much do we get? 500 rupees. So my one number is available, book value. Now let me go to the market side something. If 400 lakh is equal to 50%, if 400 is equal to 50, can I find total market cap? Total market cap would be 800 lakh. If total market cap it is an 800 lakh and you have a 2 lakh share outstanding, can you calculate the price? Price would be 400. So I got the second number. Book value per share, total book value divided by the share outstanding. Free float market cap was 400 lakh. 400 divided by 50, total market cap is 800, and divided by the share outstanding this. Now using price and P ratio. P ratio formula is price by EPS. EPS would be price by P ratio. Price by EPS. EPS would be price by P ratio. How much EPS do we get? How much? 40. Now similarly, can you calculate for me the Abhishek? Abhishek would be, sir, 100 lakh by 10. How many shares? 10 lakh. Book value 600 and this is 60. So one number. The 40% is 128 lakh. Total market cap would be 320 lakh. Total market cap 320 lakh. Divide by 10 lakh shares. Price 32. Market price is 32. And EPS would be, sir, price divided by 4. How much? 8. Now what I can do is, I can use these two numbers, 60 by 500. This is one ratio. Then I can use 32 by 400. This second ratio. Then I can use what? 8 by third. And you can multiply these ratios. Tell me the number. 60 by 500 into 0.25. You can tell me the total. Use M plus button. 60 by 500 into 0.25 plus memory plus you can do. Then 32 by 400 into sorry, EPS is, make sure EPS is 50 and EPS is this 8 by 40. 8 by 40 is EPS, so it's 50% here. And then third one, tell me the net number which comes. I think it should come 0.15 is to 1. Way of reading 0.515 is to 1 is, for every one share of the Abhishek, Abhiman will issue how many shares? 0.15 shares. Now do not flip out the slides please. Let's look at the second. He says what is the book value? That's book value per share, EPS and market price of Abhiman after the acquisition of Abhishek, assuming P ratio Abhiman remains unchanged. All assets, liabilities take on at book value. So basically even if he is issuing new shares, the combined book value would be same the book values of existing, no matter how much, what kind of accounting you do, because you will be passing some entries, you would be doing some acquisition, there could be some capital reserve, etc. In this case book value gets combined, there will be no change. Ideally whatever we get is, for example, now what will happen is, first of all I'll calculate is how many shares he had, 10 lakh into swap ratio, how many shares new, 1.5 lakh, new shares will be 1.5. The Abhiman shares were what, 2, total shares 3.5. To calculate book value per share, simplest way is, whatever way you want to do accounting, that's fine, I'll combine both the book values, that's it, because all asset liabilities are taken over at a book value. I'll just combine both the book values. It's 600 lakh plus 1000 lakh, 1600 lakh divided by what, 3.5. So new book value per share is equal to 457.14. Then to calculate the new EPS I need what, combined earnings. Combined earning would be, sir, it's a EPS 40 into 2 lakh 80, EPS 8 into 10 lakh 80, that's 160, 80 lakh plus 80 lakh divided by what, 3.5. New EPS 47.1, and P ratio remaining the same. P ratio was how much old, 10. So price would be 457.1 or 457.1. Let me show you two answers, then we'll come back to the third case. Third case will have segregation. Slide number 7. Now what I have done on this slide number 7 is, I started putting its Abhiman, Abhishek, whatever data were available from the book, I had just put in till the dotted lines. After that, since I had to calculate some numbers, it was done was, if free float is 50%, promoter holding was 50, free float is 50, market cap is 400, so fourth item divided by 7th, I've written it here, fourth column divided by 7, we get 800 lakh, sorry, and then share outstanding is 1, that's one number, share capital divided by the third number paid up, 1 divided by 3, 1 divided by 3 is basically the numbering I have given here, it's 2 lakh. Share price would be 8th column number, 8th is this divided by 9th, so total market cap divided by this we get 4. What numbers we calculated, I have shown the number wise which we have already done, and then the swap ratio calculation. Then second part we used was, new shares to be issued by Abhiman to Abhishek would be old share outstanding into swap ratio 1.5 lakh. Book value per share was combined book value divided by the total share outstanding, and that was 1000 plus 600 divided by 2 lakhs plus 1.5, it came 457.14. Combined earnings would be EPS, combined earning divided by what, total shares outstanding, so that becomes 445.714. when you multiply by what, P ratio, you get the price. That part is over here. That was two parts. Now C has 3 parts and third again I think has 2 parts. So let's verbally discuss first before we come back here. The C part says, calculate, in C first part, calculate promoter revised holding. Now let's try to calculate the promoter revised holding. Abhiman Limited and Abhishek, he was holding how much percentage? 50 and 60. 50 and 60. Total share outstanding in Abhiman were what? 2 lakh. Out of 2 lakh, his would be what? 1 lakh. New shares issued how many? 1.5. 1.5 into 60? 0.9. So his combined total shares would be 1.9 lakh, and total shares I think we calculated somewhere here 3.5. So out of 3.5, he will be holding 1.9 percentage wise, 54.29 percentage. So if out of 3.9, sir, how did you get 1.9? Abhiman, he was holding 50 lakh. Earlier it was 2 lakh. So out of 2 lakh, 1 lakh he holds. In new issued share out of 1.5, he'll be getting what? 60 percentage. Total would be 54.29. Out of 3.5, 1.9 is what? Promoter. So free float would be what? If promoter is holding 1.9 out of 3.5, free float would be 1.6. If I ask you calculate the free float market cap, 1.6 share into what? 457.14, 731.4. This is the free float market cap. Then next part he says, this was free float market cap. Also calculate the number of shares, earning per share, and book value means book value per share here. If after acquisition of Abhiman Abhishek Limited decide to issue bonus 1:2 and stock fully paid up. Bonuses for every 2 shares you'll get 1 additional share. It's a capitalization of reserves. So book value there is no change. Entry is reserve debit to the share capital. So basically you'll get the new shares. How many shares you have before the bonus issue? 5. The new you will get, sir, what? 3.5 into half extra you will get 1.75. Total number will be, this is after the bonus, 5.25. Now 100 rupees note subdivide into 5 rupee note. If I say the wealth has to remain same, 100 rupees note, I tell you give me the 5 rupees note. How many notes of 5 rupees you will give me? 20. So he says convert as 5 fully paid up. It means 100 rupees paid up value you had here, and that will become what? 5 rupees 20 times. So 5.25 face value or paid up value is 100. For 5 paid up value, this will be multiplied by 20. How many shares? 105. Combined earning, no change. Combined earning is still, earning is same. Earning per share will change. So 160 lakh was combined earning, I think. 80 lakh plus 80 lakh, 160 lakh divided by 105. EPS would change. And second is book value. Total book value will not change. It's a capitalization of reserves. So no change is coming. So total was 1600 lakh divided by what? 105. How much do we get? 1600 lakh divided by 105. So basically we have here number of shares after the bonus. Equity share bonus 5.25. If paid up capital is 100 split into 5, the number of equity share will increase by 20 times, and this will be 105. Combined earning will remain same. New answer is 1.524. And this. Now quickly you can go through it, please. You can only make a mathematical mistake, otherwise we cannot expect a mistakes in these type of questions. Quickly go through it, please. Whenever he gives you any kind of a data, do write down acquirer target, and then step by step when you do, things will become easier for you. Next question what we are covering is (44). November 2013, this question came for the first time. After that 2 times more I think has come, 1 or 2 times. November 2013 remains one of the toughest paper in the history of the SFM, AFM, or anything you can call it as. And this question, when it was framed, during that time SEBI guidelines were changed, and recently what I was telling you, that if paper setter is keeping himself updated, he will make the paper in tandem with practical scenario. this whatever you'll find here was exactly happening that time. I think this came in 2013 November, and 2011 or 12 the guideline came that any promoter who is holding more than 75% shares, then either he has to delist, that means open offer, give it to the open offer and buy the rest of the share from the public, or bring the holding below 75. That still is applicable as of now. At that time there were a lot of companies, and I remember research could have been done aggressively during that point of a time. This question came in the exam, which is based on the similar parameter. It says Trupti company promoted by a multinational group, International Inc., is listed on stock exchange holding 84%, 63 lakh share. I'll read once, then I'll read the question. Profit after tax is available. Free float market cap is available. As per the SEBI guidelines, promoter have to restrict their holding to 75% to avoid delisting from the stock exchange. Board of directors have decided not to delist the share but to comply with the SEBI guidelines by issuing bonus shares to minority shareholders. By issuing bonus shares only to minority shareholders while maintaining the same P ratio. Calculate P ratio, bonus ratio, market price before and after bonus issue, free float market cap after the bonus share. Basically what has to be done is we need to calculate these parameters, and keeping in mind he is holding as of now how many shares? 84. He has to bring back to 75. Help me out verbally first please. 84% is equal to how many shares? 63. Can you calculate total number of shares? 75 lakh. If total are 75 and 63 are held by promoter, minority shareholders is equal to 12 lakh. Profit after tax is 4.8 crores. And if I ask you calculate EPS would be 4.8 divided by 0.75. Be careful, not 1 2. Profit after taxes for everyone. It's 75 lakh shares divided by 0.75 is in crores. How much do we get? 6.4. Free float market cap, sir, how do we calculate? Free float market cap is equal to free float shares, that 0.12 lakh into 12 crores is basically 0.12 into share price. Using this, can I calculate the share price? Sir, once again, free float market cap is nothing but free float shares into share price. Free float shares are minority shareholders. It's 0.12. 0.12 into the share price is 19.2. We get 160. Using 160 price and using 6.4, can we calculate the P ratio? P ratio, first part he asked, P ratio is equal to 25. The first part answer is 25. Basically what we have done, we have just seen the EPS and price. Using price and EPS we calculate P ratio. Now he says you have to issue share to minority shareholders. Now he is not changing his shares. 63 lakh will remain 63, but percentage wise it has to come to what? 75. If it has to come to 75, then total number of shares would be equal to what? 84 lakhs. Earlier how many shares? 75. New shares would be 84. How many new issue? 9 lakh. 9 lakh will be issued to whom? Minority. So bonus ratio would be 9 lakh is to 12 lakh. That's 3 is to 0.75 is to 1. Then he says market price before we have already calculated 160. After the bonus issue. After bonus issue would be, how do you calculate? Calculate new EPS. Calculate, sir, new EPS. What we'll do is, will any change in the PAT level come? No. PAT will be 4.8 crores. Any change in the number of shares? Yes, 0.84. New EPS would be equal to 5.71 into P ratio will remain same. P ratio was 25. How much price do we get? 142.75 or 85 approximately. And then he says calculate market free float market cap. Free float market cap would be equal to how many free float shares? 12 lakh earlier. How many new issued? 9 lakh. Total will be 21 lakh into price is 142.75. 299 0.75 lakh or approximately 30 crore. Now you cross check the quickly check the answer. 40, slide number 9. Quickly cross check the answer, please. Second time when that came, I think they missed out the motor holding. You could have assumed something. Ever since they have given right. Next part is accretion dilution. I'm on 10th slide. Very important analysis. This is actually kind of a post-mortem analysis which happens after the deal, because litigations happens once the deal happens. Is because target company shareholders can say we were undersold, acquirer shareholders can say we overpaid. So to avoid any kind of litigations, this kind of analysis is done by the M&A bankers in the company, so they can show the proof that we have done ample analysis and this was justified deal. For your case, it will not matter accretion dilution. He'll give you the question. This point which I have given here could be one of the MCQ questions or can come as the interview question part here. Accretion dilution analysis. Accretion is word comes from accretive. Dilution is a dilution which you have dilutive. EPS, when the deal, after the deal EPS increases, we say deal is accretive or accretion. When the EPS after the deal dilutes or decreases, we call it as deal is dilutive. These are common terminologies used. Dilutive EPS you would be using in the FRO accounts also. Accretion dilution analysis. Now one of the questions which has come in exam, they have mentioned this line. I'm just focusing, even if they do not mention, this will happen the same. If a high P ratio, for example, let me put down some number. Let's suppose there are two companies, A and T. The EPS of A company is 10 and B company is also 10, I'm assuming. Price is 100, price is 70. If I calculate their P ratio, 10 times, this 7 times. There are two ways of reading this. Two ways. One way is 10 could be read as per rupee of earning you are paying 10 rupees price. Per rupee of earning you are paying how much? 7 rupees price. Second way you can say a payback period from the capital budgeting. That if you earn 10 rupees today, 100 rupees, 10 years recovery will take place. If you earn 10 rupees, 70 rupees you pay and 7 years will take place. In both the cases, A is looking expensive. A is looking expensive because payback period is kind of 10 years, or per rupee of earning, proportionately you are paying how much rupees? 10 rupees. Now the point says same thing. If a high P ratio company, that is acquirer, acquires a low P ratio company target, then deal would be accretive for the acquirer, that's A, and dilutive for the target in all stock deal. Why is it happens is, for example, I have a high P ratio, you have a low P ratio. Let's suppose deal is happening on equal basis. Sorry, let's suppose deal is happening on equal basis, 1:1. Let's suppose that in that case I will take away your company and give my company. Pricing of my share was done in such a way that per rupee of earning you are paying as if how many rupees? 10, and your per rupee of earning I am acquiring at what? 7. So this shows the same thing, which practically also will come exactly same. If a high P ratio company acquires a low P ratio company and it's an all stock deal, deal would be accretive for the acquirer and dilutive for the target. That means beneficial would be the acquirer company which comes out. So this is just a point which comes here, because acquirer is an expensive company. Basically expensive company is issuing shares to the cheaper company. Now one question I have taken, which I'll modify in different parameters. Of the late we have started seeing your institute framing questions on those parameters. Question number 4. 4. Welcome. Sorry. It says B Limited is a highly successful company and wishes to expand by acquiring other firms. Whenever you feel slightly faster, let me know, because your expression tells me you're comfortable. By expression, I'll come to know your expressions are like this only, then you only tell me. No. From Bhav. Not fast, na? I understand your bhavna. I understand your understanding. In case you feel, because I know which topic I have to slow down. By prima facie, I'll come to know, don't worry, this will come soon. Just a base work. Without this base work, actually, I could have avoided this and could have jumped, because some of you would be waiting for forex, some of you would be waiting for derivatives. Then cases would be, so instead of that, let me cover the weightage marks wise. My preference is exam passing also, not about, because generally we have a tendency, complex is complex. If complex is complex, it's not necessary we are playing a test match, it's not necessary we have to play every ball. Let's secure our 80% of the weights. Out of that, if I finish off this chapter, if I am good enough or my luck is good enough, lower side you'll have 30% from the first 3 days till here, upper side you can have 45% weight. That's heavy. And if you have a similar question, at least your comfort on that comes in. Forex is simpler. I have my own way of doing it, because I would change your thinking. If you have studied from me, you'll be comfortable. If you have not, then you have to forget everything of the forex and come back. Hence, I'm creating that base work for the forex. Derivative is one of the simplest chapter. Not tough. It's only prima facie we have assumed, because you do not look at the equity markets. Once you look at the basic, then there's no problem. Portfolio is formulas. Capital busting is all labor work. So they have reintroduced. 2018 before it was there. Went to the modified course, then reintroduced modified course. So modification is easy na, remove and then add back, modification happens. I don't know what they have done now. So copy pasting exactly. Most of you would have done the intro also, I think, if you would have done a new course. The same thing they have come up with the finals. This question will look very easy to you, but this will help me in framing one practical insight of the valuation. Prima facie, when I read this question, let me read out, I'll tell you. You will say 99% will give me the same answer when I'll ask. An answer will be yours and mine would be same, but thinking would be different. B Limited is a highly successful company and wishes to expand by acquiring other firms. Its expected high growth in earnings and dividends is reflected in P ratio of 17. That's one number of the B Limited. The board of directors of B Limited has been advised that if it were to take over the firms with the lower P ratio than its own, using share for share, it's not 1:1, my share I'll give and your shares I'll take, then it could increase reported earning per share. First 4 lines are only justifying that board meeting has happened and they want to acquire some company. C Limited has been suggested a possible target for a takeover with a P ratio of 10, 1 lakh shares in issue with a share price of 15. So C Limited data is P ratio 10, 1 lakh share price 15. After full stop, I have B Limited 5 lakh in issue with share price of 12. Calculate the change in earning per share of change in earning per share of B if it acquires the whole of C by issuing the shares at a market price of 12. Assume the price of the B remains constant. Let me summarize the question. B wants to take over C Limited. B has a P ratio of 17 and then some data of the B is given, some data of C is given. He says, after full stop, from here I am reading, calculate the change in earning per share if it acquires the whole of C by issuing its shares at rupees market price of 12. How would I find the number of shares? Or how would I find the EPS? Let me talk. What we have to find is new EPS. Na? New EPS is what? Combined earning by total share outstanding. Combined earning is easily available in the question. B Limited share is available. We want to find what? New shares. How would you find new shares? He says calculate the change in earning per share B if B Limited acquires the whole of C by issuing the shares at what market price of 12. Hmm? Swap ratio. How do we find swap ratio? Basic purpose is I need combined earning which is available. I need total share outstanding out of which B is available. The moment I know C shares, my work is done. My question to you is how do you find the number of shares to be issued to C Limited? This is actually the problem. In this question, even if you use that market price, the answer would come same. Actually, the way of doing this question is not the swap ratio. This is exactly what you do in accountancy. What you do in the accounts is or FR paper is to find purchase consideration, divide by the number price, issue price, you get the number of shares. In this question, whether I take swap ratio in the form of MPS or I calculate the purchase consideration and divide by 12, my answer would be same. Practically deal never happens, and actually what happens is when let's suppose someone is acquiring A is acquiring a tea company and the market price of tea company is the tea company here C is target 15. C will not sell itself for 15. It has to be sold at some premium. Now the premium is I think only once or twice has come in an exam, otherwise they never ask. 99% deals in the practical life will happen at a premium. That will not happen below this premium level. That means in this case, since nothing was mentioned, it was assumed if C would be acquired, C would be acquired at a market value. So basically what has to be done is you have to calculate purchase consideration that is as good as the market value. That market value when you divide by 12 you'll get what? New shares. But even if you try that sir if I use the swap ratio MPS of both of them answer would come same, in this question it would come same because there is no premium concept involved. But the correct way of doing this question should be, it's not the swap ratio. The correct way of doing this question would be, it's a B Limited, B I have 11th slide I'm on, it's B and C are there, P ratio available, share outstanding, share price. EPS I'll calculate both of them, market cap I'll calculate, it's 60 lakh and it's 15 lakh I think came, how sir, it's 1 lakh into 15 lakh market cap came, earning comes 0.71 into the share outstanding and this into the share outstanding. Important is if nothing is said, we assume that acquirer will take over the target company at its what value? Market value. Even if you use MPS swap ratio, answer would come same. In the next slides, I'll change this question slightly to adapt to the practical scenario. Now, in this case, what is here? It's a market value that is as good as purchase consideration. It means they will make payment to the C by acquiring C at its market value of 15 lakh. That means number of shares to be issued by B to C would be, what you do in the accounts is purchase consideration divided by what? Issue price or market price. That's 1,25,000 share and this gives you what? 6,25,000. So new EPS would be equal to combined earnings divided by what? Total shares outstanding. That comes 0.81. And we wanted to prove that basically EPS old was 0.71, new EPS would be 0.81. EPS after the deal has increased. Yes, it can be seen that if B Limited acquires C Limited, then the EPS will increase from 0.71 to 0.81. That is what we just wanted to justify. Objective was not this proof. Objective was if nothing is said, deal would take place in the ratio of what? Market value. Market value means basically he said I'll issue the shares at this price. Now you need to know that value. What is the value? Once you know that value, divide by the issue price, then only you can calculate what? Number of shares. It will be there. So this was this part here. After in the next slides, I think I have, let me add that, let me take some scenarios. I'll show you from my, give me a minute. Go through the slide, go through it. I'll add few points here. Just go through fourth question, please. This slide might not be with you. I have few cases I have taken here. I'll show you how practically deals will take place. You can see from my, it's not difficult, it's only to add something new. Same question data. If I would have increased, if B Limited acquired C Limited at a premium of 25%, find the new EPS if it's a all stock deal. It means basically what has to be done is market cap of C is 15 lakh. Deal is happening at a premium of 25, that means additional of 375, total becomes what? 18 lakh 75. 1875 issued at what price? 12. You'll find new shares that comes 156, 250. So total shares outstanding would be equal to 5 lakh plus 156, 250. It becomes 656, 250. Your new EPS would be equal to 505 divided by 6 lakh 56,250. That's basically total shares outstanding which were here. This comes out. Similarly, second case is something which is part of only few questions. B Limited acquired C at a premium of 25. It means if the market cap of C Limited is 15 lakh, they will be given plus 25%. It's a cash deal. It's a cash deal. So, cash deal means, it means the amount to be paid in cash. Interest is 10%. I think Tata Chorus was all cash deal. For example, the cash deal, there could be some stock deals also, cash deal. The amount to be paid in cash, interest to be 10%. Calculate the EPS given the tax rate is 30. Now what happens in this scenario is, I know I have to make a payment to the C Limited. How much? It's a 15 lakh plus 25, that's 18 lakh 75. If I issue them shares, then my number of total shares increases. If I give them cash, there are two possibilities. Either I'm using my own cash or I'm borrowing. Generally we have a leveraged deal. Leverage means they borrow and do the dealing. So if I take the loan from outside and do the deal, 18 lakh 75 would be loan taken, cash inflow, cash paid, target is done. No new shares increased. Only thing is the additional cost will hit my income statement. Income statement will have a hit of 18 lakh 75,000 into 10% into 0.7. 30% would be a tax saving which comes. So we have to make a payment of 1875. If I have to make a payment of 1875, I'll say 1875 interest cost 187,500. I'll save tax on it. So my net interest cost is 131,250. So my combined earnings, my concept will be combined earnings minus the net interest cost. There will be no new shares. Old shares for how many of the B company? 5 lakhs divided by 5 lakhs. This comes here. That's a cash deal. So this is basically one part I've taken as a stock deal, one part I've taken as a cash deal. Now third part which I'm taking, I'll show you the data, you calculate the answer. It's a combination of cash and stock deal. I'll rub out my answer. You can help me out. This is not there with you, don't worry. Only from here you can see so that you're comfortable. I'll cover up the question on this. The question is case 3. Case 3 is basically it. B acquired C at a premium of 30%. Consideration to be discharged 40% in the form of cash, 60% in the form of share. Find new EPS if interest rate is 10%, tax rate is 30. And the data remains same of question number 4. B and C. Quickly calculate for me new EPS. Calculate for me the new EPS, please. It's a cash and stock deal. In the meantime, anyone who has done can check. Facebook has acquired WhatsApp. Wrong, back. Check. Was it a cash deal, stock deal, or cash and stock deal? Company Cadbury. If anyone has done, they can check. Second deal, they can check. Cadbury was acquired by some company long time back. Cadbury. Cadbury, sir. Facebook, WhatsApp would have been cash and stock deal, I think. Cadbury was acquired by some company. They've not changed name. Kraft. Now, actually, time does not permit me. Else, there's such beautiful chapter. We discuss the strategies why it happens. They've not changed the name Cadbury because the moment they say Kraft, 90% of people not know the spelling also of Kraft. Kraft, Kraft, Kraft. Which Kraft? I'm saying Kraft is much bigger than the Cadbury. But since Cadbury is the much sellable chocolate brand in the India and China, as of now you see Rishto Ka Bandhan, tomorrow you come to know Kraft, you say, which Rishta? Gone? Does not happen. Strategically, deals when happen, what you are doing actually you are doing numbers, so we cannot help it out. In exam he cannot ask you. But strategically you should know when deals happen, the deals happen such a way that they have to keep the intact the branding also to some extent. When Vodafone came to India, Vodafone acquired a company called Hutch 2007 Feb. That was again a time when the bull run was one side. 2007 they acquired, and since Vodafone is one of the very big players of the world, maybe larger than or equal to China Mobile, so that's basically one of the largest players we have. So they were able to change the name to Vodafone. It did not find much difficulty, but still they used the same advertisements. Starting the Zuzus used to come, then the IPL Zuzus, after Zuzu some had European advertisements that used to come jing 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 jing. Then they realized India do not have jing 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 jing. Then Indian psychology they understood, came to India by the time Geo came in, then everything went for a toss. So sometime it is not about the changing of name. Name has to be kept same, and sometime it's they change altogether. Whitewash, then come new. Strategically, deals happens. Why deals happens is for certain reason. It could be acquisition of the market share. It could be basically they want to go into the some new market and etc. So this Kraft and Cadbury, I think 2009-10 deal would have happened. They acquired, it was same a stock and a cash deal. Same as Facebook and WhatsApp also, I think stock cash deal. Maybe go back home and read out about them. The market value of C is 15. If you got the answers, I'll just quickly cross check. It's 15 lakh, 4 lakh 50. Consideration comes 19 lakh 50,000. So once we have 1950, cash is how much? 40. Stock is how much? 60 percentage. The this comes what? 7 lakh 80. This comes out what? 11 lakh 70,000. Interest amount 78. Tax saving same. Interest cost. Now in this case, new shares will also increase plus the interest, and then these are number of new shares. I think you would got the same. New EPS I get is 0.75. This type of a question has come in the exam, which knowingly unknowingly you have done, might not have come across it. Just check question number 45. That was stock and a cash deal. Stock and cash I think has not come. It have cash deal. 45th question. 45 45. 45th question number. It says the CEO of a company thinks that shareholders always look for EPS. Thereafter, he considers maximization of EPS as his company's objective. His company's current net profits are 80 lakhs. P multiple is 10.5 times. He wants to buy another firm which has a net income of 15.75 and P multiple ratio is one and the same thing. Practical life they call it as a multiple. P multiple of 10 times. What is the maximum exchange ratio which the CEO should offer so that he could keep the EPS at the current level? That means if EPS has to maintain, deal will take place in what ratio? EPS ratio. EPS ratio do we have, we can calculate. Here, don't worry. Which CEO should offer so that it keep the EPS current level given the current market price of both the acquirer and the target company is 42 and what? 105. Acquirer target 42 and 105. Using P multiple and share price, we can calculate what? EPS. P multiple 10.5 and 42 and 105 and 10. I can calculate. Can tell me the ratio or multiple of acquirer target. That is, acquirer is 10.5, target is 10, price given is 42. Calculate the EPS for me. 4 and 10.5. If maximum, although maximum exchange ratio is a separate topic altogether, but in case we want to follow, if deal happens in the ratio of the EPS, then the EPS can be maintained. Basically, how much do we get answer? 10.5 is to 4, 2.625 is to 1. That means if deal happens in the ratio of 2.625 is to 1, then the EPS can be maintained. Second level he says is, if the CEO borrows funds at 15% and buys out the target company by paying what? Cash. That's basically cash deal now. By paying cash, how much should he offer to maintain his EPS? Now he's reverse asking you calculate loan amount. So loan amount, what we'll do is, you want to maintain what? EPS. Look up, please help me out. If you want to maintain EPS, that means his EPS is what? 4. His EPS is 4. EPS formula would be, if I try to put it, and always whenever you face difficulty, just try to put the simple formula. It's combined earning minus what? Net interest cost divided by what? Shares outstanding. Since it's a cash deal, I have this 4 available. Combined earnings is what? Do I have the combined earning available? Sir, if I have the EPS available, 4 into combined earning is 80 and 15.75. How much? 95.75. Net interest cost would be loan I don't know. Let's suppose loan is X amount. Interest I pay how much? 15%. Then I save how much tax? 30. Can I do into 0.7? I can do into 0.7. X is my loan amount, 15% is my tax, into this net interest cost, divide by what? Number of shares, how many? 20 lakhs. You reverse calculate this and calculate the X value for it. So once again, he want to maintain, look at the language. If CEO funds at 15% by paying cash, how much should he offer to maintain his EPS? That means he has to make sure EPS is 4, and my EPS formula is nothing but combined earnings minus the net interest cost divided by the share outstanding. So net interest cost would be, sir, loan amount into 15 into 0.7 divided by 20. How much do we get? 150. X value is 150. X value 150 lakhs. The way of reading is, if he takes a loan of 150 lakh, then he can maintain his EPS of what? 4 rupees. Fine. Let me answer now. When you go back home, please redo all of them. You should be comfortable. Look at the answer. Understand the flow, please. It's not that I create a format. The way I think, the format automatically gets created. Unlike maybe some of the formats what you learn. In this case, there is no kind of format. The way you think, make your numbers accordingly. A very interesting question on the cash deal. Cross check the numbers. Fine. Next question is one of the very important questions of this chapter. I love this question. I don't know why, because a lot of questions are based on this same philosophy. Question number 19, AFC acquiring BCD. Number 1919, AFC BCD. Actually, you should be able to speak the names, some conventional questions especially. Abhiman, Abhishek, Rama Krishna, AFC BCD, Trupti Limited. By that you will get comfort level. This question similar to what? AFC acquiring a BCD. Question number 199. Though there could be a possibility answer is given in the book, will not look at the book answer, please. AFC Limited wishes to acquire BCD Limited. AFC is a target acquired company, BCD target. The share issued by two companies are 10 lakh and 5 lakh respectively. That's number of shares. Calculate the increase in the total value of BCD resulting from the acquisition on the basis of following condition. Increase in the value of BCD means value of the BCD after acquisition minus value of BCD before acquisition. You have to calculate the increase in the value of BCD. Current expected price growth rate is 7%. Expected growth rate under the control of AFC would be 8 without any additional capital investment and without any change of risk in operation. Means rest factors will remain same. Maybe the KE will remain same. So growth will change from 7 to 8. The moment the growth changes, price would automatically change. Current market price of AFC is 100. Current market price of BCD is 20. Expected dividend of BCD is what? 0.6. Expected dividend of BCD is 0.6. Now basically if I ask you increase in value of BCD, increase in value of BCD is nothing but value of BCD after acquisition minus value of BCD before acquisition. Before acquisition is straightforward, it's a 5 lakh into what? 20. How much is the value of BCD before acquisition? 10 lakhs, 100 lakhs or 1 crores. Now my objective is to calculate what value of BCD after acquisition. Since growth is changing from 7 to 8, since dividend is given, formula would be D1 divided by KE minus G. The moment I apply D1 divided by KE minus G, I know D1 is 0.6, G is 0.08, missing is what? KE. So what I'll do is, using the existing growth, using the existing price, using the dividend, I'll calculate KE from the inter chapter called cost of capital. E1 divided by E plus E. E1 is 0.6, price is 20, E is 0.07. What is your existing KE? How much? 10%. And he has clearly mentioned, even if he would not have mentioned, now we'll still assume the risk factor will remain same, that means KE will remain same. So if use this 10 now on the above part here, D1 is 0.6, KE 0.1, growth changed to what? 0.8. How much price? That means share price will increase from 20 to 30. If 5 lakh shares are there, 5 lakh into 30 value would come what? 1 crore 50 lakh. So value would be 1 crore 50 lakh and this get here. increase in values. Any doubt comes here? Done. I start getting a doubt here. I don't know why every time. Price formula is D1 divided by KE minus. When 8% growth was there, dividend was 60 paisa. When 7% growth was there, still the dividend was 60 paisa. I don't. Student never get this doubt. I only get. I don't. Same is my problem. AC direct. I think within 2 days. You have the option. I don't have the option also. He shifted his place below AC, without AC, no AC. I don't have that option. I was telling. Problem comes here is 60.6 dividend when the growth is 8, when the growth was 7, still 0.6. Go back to security valuation, question number 14, CMC PLC. In your book, I gave you 14 or 12, I don't remember. CMC PLC. I told you you will face this problem at a number of times. If you would have, if question would have given D1 is equal to D0 into 1 plus G, then you reverse calculate. Since nothing was mentioned, I will not change D1, assuming D1 would have been based off EPS 1. Understand what I am saying? I am not trying to change, although I would not be surprised at some time your institute will change it, but that will not be valid stuff. Either you should tell me that this how D1 was calculated. If D1 was calculated using D1 into 1 plus G, then I should reduce that 7 and add 8%. My D1 would change. Since I do not know how the D1 was calculated, I am assuming maybe would have been done using what? EPS and EPS 1 into dividend payout ratio. We are not changing anything here. The answer is right. It comes 50 lakh. Second part. On the basis of aforesaid conditions, calculate the gain or loss to the shareholders of both. If ABC were to offer one of its share for every 4 shares of BCD. Now, aforesaid condition means you will calculate gain or loss in the market value term or the earning terms. It will be market value. He did not even discuss anything on the earning term. He did not discuss anything in the first part. Even if you try earning term, you do not have any data to calculate in the first part earnings term. The first part he spoke about was the market value. Also, no matter how you do the mathematics, you should be ultra clear. What exactly are you doing? You are dividing this 50 lakh gain into AFC and BCD. That's it. Understand what I'm saying? In second part he says, on the basis of aforesaid conditions, calculate the gain or loss to the shareholder of both companies if offered blah 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 these shares. It means whatever gain you've calculated in the first part, that came 50 lakh. That 50 lakh gain basically would be divided between AFC and BCD. That's it, nothing else. No matter how I do the mathematics. Now what we'll do is, let's do it verbally please. Let's do it verbally. Since it's a market value, it has to be market value because in the first case there is no data available for the earnings. Help me out. If what is the swap ratio? 1:4. Instead of 5 lakh new shares would be issued what? Instead of 5 lakh new shares would be issued what? 1.25. That's 1,25,000. 1,25,000. Total share outstanding will become what? Because instead of 5 lakh shares have become what? 1,25,000. 10 lakh plus this, total shares will become 11,25,000. What was the now what we can do is, what will be the value after the merger? Value of the merger would be value of AFC, value of BCD plus that gain. Then gain is nothing but 50 lakh. AFC value would be, sir, what? AFC value would be 10 lakh shares. 10 lakh shares into 100. That comes what? 10 crores. AFC value is 10 crores. BCD value alone was 1 crore. Gain is what? 50 lakhs. So total combined value is 11 crore 50 lakh. If total combined value is 11 crore 50 lakhs, and how many shares you have? 11 lakh 25,000. So when I divide by 11 lakh 25,000, can I get the share price? How much is the share price? 102.22. Now please look up that means new share price would be 102.22. I have done nothing. AFC value alone, BCD value alone, plus that gain. Total market value divide by the new shares outstanding 102.22. What was the AFC value alone? 100. The price will increase to what? 102.22. So AFC shareholders will gain how much? 2.22 into how many shares? 10 lakh. So AFC gain would come, sir, 2.22 into 10 lakh. How much? 22 lakh 20,000. Actually, if I want, I can put BCD as a balancing figure. Total is 50 lakh. But let me show the calculation. Swap ratio was what? 1:4. That means they're sacrificing 4 shares and getting 1 share. What was the share price of BCD alone? Single share 20. How many? 20 rupees was single share price. How many shares they are sacrificing? 4. 4 into 20, 80. 80 rupees they are giving. In return, they are getting 1 share whose value would be equal to 102.22. So 102.22 they'll get, sacrificing 4 shares. 1 share 20 rupees minus 80 into total shares are what? 1,25,000. How much we get? 27,78,000. It's rounding off will come problem. Understand what is the second part? No matter how you want to show the mathematics, when he says depending on the first aforesaid condition, tell the gain or loss, they have to divide this 50 lakh. That's it. They have to divide this 50 lakh. If by chance you calculate first AFC, what we did was we calculated the combined market cap plus the gain, total market cap divided by the total share outstanding. We got new share price minus the AFC. Since base is same, new share price minus old share price into 10 lakh, we get total gain for the AFC. You can have from 50 lakh minus AFC would be BCD, or you can do is BCD sacrificing 4 shares. 1 share was worth rupees 20, 80 rupees they are forgiving, and they'll get new share at what? 102.22 into total 1,25,000. This will be the gain of BCD. Total will be rounding off equal to 50 lakhs. Which, let me show you the first two parts. Third part we'll discuss. If I look at the first parts, first part was straightforward 19. I'll just quickly go through the slide. It was increase in value of BCD, value of BCD after acquisition minus value of BCD before acquisition. BCD before acquisition is nothing but 1 crore. Existing KE is nothing but 10%. Using that same, we calculated new share price. When the growth becomes 8, it came 30. So value of BCD after acquisition was 1 crore 50 lakh minus 10 lakh, it comes 50 lakh. That was one part. Second part, in second part we have done is swap ratio is what? 1:4. New shares to be issued 1,25,000. Total shares outstanding 11,25,000. Pre-merger value AFC alone 10 crore. BCD alone, sir, 1 crore. Increase in value of BCD 50 lakh. Total becomes 11 crore 50 lakh. 11 crore 50 lakh, when we divide by 125, we get share price as 102.22. Gain to the shareholders of AFC is 1022.22 minus 100 into shares. BCD, sir, BCD would be 102.22. They are sacrificing 4 shares into 20, 80 rupees, and number of shares are 1,25,000. The total should be approximately 50 lakh. In exam, if you feel, sir, we are not getting exactly, you can write here approximately, and then you can add one sentence if you want, which I want. I don't know the examiner what mindset, because they check number by number. For example, if exam papers checker or the examiner would have given the answer 50 lakh minus AFC, balance is BCD. You can say rounding off that basically total gain of 50 lakh has been divided in AFC and BCD, so that at least the argument point is there. I don't know whether he'll give this answer or whether he'll give 50 lakh minus something, but it's 50 lakh only which is getting divided. This is the second part. Third part is a cash deal. Once you've done this, we'll go to the third part. Third part was a cash deal which comes out. Let me discuss verbally the cash deal. Look at the data, please. It says calculate gain to the shareholders of both companies if AFC pays 22 for each share of BCD. Now it's a cash deal, so instead of 20 rupees was the share price of BCD, they are paying how much? 22. 2 into 5 lakh share, 10 lakh is the gain of BCD. BCD is over. In BCD case is done. That means their value was 20. They paid how much? 22. 2 into 5 lakh. The 10 lakh is done. How much total cash they paid? 22 rupees into 5 lakh share. First line they have given. How much? 1 crore? 1 crore 10 lakh. Now, assuming P ratio of AFC does not change after the merger, EPS of AFC is 8, that of BCD is 2.5, and then he says it is assumed AFC would invest his cash to earn 10%. Basically, they want to calculate new EPS. When they speak about P ratio, they'll calculate new price. The new price they'll calculate compare with the old price. Only AFC is left, BCD is done. Now, how do I calculate new price? New price is P ratio into new EPS. New EPS would be combined earning minus the interest cost or opportunity cost divided by shares outstanding. Help me out verbally. How many shares of AFC? 10 lakh. BCD? 5 lakh. BCD 5. Right? Now let's calculate their earning. EPS of AFC is 8. 10 lakh share. Earning of AFC would be 80 lakh. Plus BCD share how many? 5 lakhs into 2.5, 12.5. How much cash did we pay, sir? We paid 22 into 5 lakh. 22 into 5 lakh, 1 crore 10 lakh. If 1 crore 10 lakh I would not have paid, that was earning for me how much? 10%. So what is my opportunity cost? Which will decrease my income? Minus 11 lakh. Tax is not given, we are not doing anything. Minus 11 lakh. Divide by the share outstanding will remain what? Same. Sir, what are we doing? We are finding new EPS. New EPS is nothing but earning of AFC, earning of BCD, minus the opportunity cost, divide by the share outstanding. AFC shares are how many? 10 lakh. How much do we get? 8.15. Actually, deal is accretive for the acquirer, and we should know prima facie why. Because when you acquired BCD, income from BCD came what? 12.5. Cost due to BCD came what? 11 lakh. So deal has to be accretive for the acquirer. That means acquirer would gain 100%. He would be gaining. So new EPS is 8.15. P ratio, sir, how do I find? Price of AFC in the first point was given 100. The EPS is 8. P ratio 12.5. If I multiply this into 12.5, I'll get the new price 101.875. So gain is nothing but 1.875 into 10 lakh. That's the gain which comes. So nothing we have done. Using this data, we have found the new EPS. Using new EPS and existing P ratio, new price minus the old price is the gain for the AFC into the number of shares. Which can I show you? In answer, I do in detailed version actually. But what basically I have done is third part. In the third part, BCD is paid 22 in cash. So gain to the shareholders of BCD is nothing but 22 minus 20, 10 lakh. Existing P ratio of AFC was 12.5 times. Earnings of AFC 80 lakh, BCD 12 lakh 50, 92 lakh 50,000. And then I have done is opportunity cost. Cash paid to BCD 1 crore 10 lakh. Cost is 10%, 11 lakh. That will hit my income statement. New EPS would be 92 lakh 50 minus what? 7, 8.15. And new price comes 1.875. Actually, you could have directly calculated the gain. Your old EPS was what? 8. New EPS is 8.15. That 0.15 into the P ratio will be direct gain. That 0.15 into P ratio would be the direct gain which comes out. It will be 18,75,000. Quickly check this out. A very, very important question. AFCB. Quickly go through it. AFC acquiring BCD, and that was a cash deal. One or two cool down exercises before we move to the next topic. Question number 29. You do it on your own, please. Question number 29. Do it on your own. It's a general question. It's nothing but a cool down exercise. Couple of questions I'll do so that if anyone wants an emergency break, they can go up and come back. It's up to you. You have to calculate the gains. Basically, that's the second part of AFC BCD question. Basically, second part of AFC and BCD. He has saved some time for you. In the AFC BCD, he asked you to calculate the merger gain. In this case, he has given that gain, I think. Just have to subdivide. Nothing to be done. You find the combined value. Combined value subdivide amongst two parties. That's it. A cool down exercise. Let me read out with you. Company X plans to acquire Company Y. You are required to show the merger gains using the following data. X and Y, pre-merger market price 60/30, number of shares you have 14 lakhs and 7 lakh. Merger gain is expected to be 150 lakhs. Company X has offered share of for every one share, for every two they'll give one share. Now let me do one thing. Let me find the value of X Limited. Close it completely. Very good. 60 into 14 lakh. How much do we get? That's a pre-merger value of X. How much? 840. That was AFC alone, X alone. Y alone 210. Plus merger gain 150. Total value 1200 lakh. And then you can do is instead of 7 lakh, you'll get how many shares? 0.5. Total number of shares would be 14 lakh plus 3.5 divided by 17.5. And then accordingly you can calculate. Price comes what? 68.57. And then you can have 68.57 minus 60 into 14 would be his gain. 68.57 into 14 lakh shares. That is his value. I think that comes how much? 960 minus 840 will be what value? 120. And balance you can calculate the same way or whatever way he has given the answer. No matter how you calculate, you're basically subdividing the value. Generally, in the market value terms, both will gain. Otherwise, deal will not take place or there is no sense of the deal. Shareholders will lose out unless until the company is bankrupt. That's other way around. Otherwise, both have to gain slightly. Both the companies are good enough. Shareholders will gain. This was one cool down exercise. Second cool down is number 42. Cauliflower Limited acquiring cabbage. Cauliflower Limited is contemplating thinking of acquiring Cabbage Limited. Cauliflower is full gobi, cabbage is pata gobi. Full gobi acquiring pata gobi. I think he might be, while setting a paper, he was making food or he was in kitchen or maybe that kind. Because how do you create a paper? Whatever your feeling is, that only express in the paper. After becoming CA, you also come to know cabbage, cauliflower, everything. Don't worry. Come back. Cauliflower Limited is contemplating acquisition of Cabbage Limited. Cauliflower Limited has 5 lakh shares having market value of 40. Cabbage has 3 lakh shares having market value of 25. This is an area where a mistake can be done. Please remember, it's cabbage first, EPS cabbage is given. EPS of cabbage and cauliflower limited are 3 and 5 per share respectively, reverse given. Management of both companies are discussing two alternatives for exchange of shares as follows. So they're planning two swap ratios, one in the relative EPS per, that means they want EPS proportion. Second, they are thinking one share for every 2 share, 1:2. They have given the swap ratio, that means two alternatives are there. One deal can take place in the ratio of the EPS, second deal can take place in the ratio of the 1:2. Help me out verbally please. EPS of target by acquirer, na? Target is how much? 3. 5. How much? 1. And cabbage has how many shares? 3 lakh. So he'll be given how many shares? 1.8 lakhs. Now he says calculate EPS. Now EPS, if I calculate, EPS would be nothing but combined earning divided by total number of shares outstanding. So we have combined earning would be, sir, 3 lakh into 3. So cabbage limited earning was 9 lakh. Cauliflower was 5. 5 into how many shares? 5 lakh. 5 lakh only? Yes, 5 lakh. This will be 25. So combined earning would be equal to 34 lakhs. And 1.8 is the new shares plus 5. 34 lakhs divided by what? 6.8. How much is new EPS? 5. And you can look at this part now. The EPS of acquirer cauliflower was 5 earlier and 5 now. So there is no change. Similarly, we'll calculate for the second, which I'll ask you to do it. Second part he says, actually he says, A part he says, you do the deal in the EPS swap, you do the deal in the 1:2. And then both parts show two parts. One is EPS calculation, what I have done, and show the impact on EPS. He is not showing impact on earnings. The wordings are impact on EPS. I can easily compare EPS of the cauliflower old and new because number of shares were same. For the cabbage limited, since number of shares are changing, I'll have to calculate what? Equivalent EPS. Question number 6, third part. Equivalent EPS would be, sir, 5 into what ratio? Exchange ratio. 5 into exchange ratio, that 0.6. So 5 into 0.6 is 3. 3 and 3 will have no impact because whenever deal happens in EPS, no gain or loss would come. Quickly do the second part and then I'll show. Slide number 19, I think. Do it on your own and then quickly cross check the answer. Slide number 19, I think. Once you've done, let me know. Next, we are moving to something new part of this topic, valuation side. Slide number 15. We have something called analyst format of P&L. Analyst format of P&L. Actually, I'll be using some terms. Using the term, I'll be using some valuation parameter. We have an analyst format is basically what you have normal income statement. Whenever anyone who is analyzing the company, he'll convert as per his calculations. The formatting is done accordingly. Sales minus operating expenses excluding D&A gives a term called EBITDA. Then from EBITDA, they subtract D&A, we get EBIT. EBIT is operating profit. Some people even take EBITDA as operating profit, but operating profit is EBIT from our perspective. Minus interest expense, other income, EBT, minus tax, we get PAT. EBITDA is the most used term in the financial world. This is the most used term in the financial world. When a deal happens, for example, let's suppose I acquired some property, and I tell you I acquired a property for 2 crores. Now, how do you tell me whether deal was expensive or cheaper? How do you come to know whether property is bought cheaper or expensive? Value, I told you 2 crores. Let's suppose you go and try to buy a property. Let's suppose you go and buy a property. What do you do? When you buy a property, how do you come to know whether property is expensive or cheaper? Standard deviation, stamp duty. I know your article, reach above article, you become chartered accountant, big salary is coming, and then go and buy a property. Now, like, if someone tells you you go and property dealer, he says it's a 1 crore. How do you tell him it's expensive or cheaper? How do you come to know? Surrounding you'll see, but you see the area also, no? For example, let's suppose I say 1 crore property you bought, 1000 square feet. If you are buying 1.2 crore and same 1000 square feet, you compare on per unit basis. How do you compare that? 1 crore divided by 1000 square feet, that becomes 10,000 square feet area. Whatever rates, maybe square feet or some other, you find out exactly same way. Now, deal, for example, Tata acquired Chorus, I think, maybe 6-7 billion deal. Vodafone acquired Hutch around 18 billion, and same Facebook, WhatsApp could have been around 17-18 billion dollars. Now, 18 billion is cheaper, costlier. How do I tell my shareholders that what deal we have done? They calculate something called EBITDA multiple. That's they acquired. For example, I paid for property 1 crore. I came back home. 1 crore is a number. 5 crore is a number. 50 crore is a number. Now, per square feet, how much I paid? I paid per square feet. Let's suppose 900 rupees, 9,000. Whereas the value was 10,000 square feet. I say deal was done better off. The amount is not important here. Important is that multiple. For example, if I acquired some company on the EPS, let's suppose I say the earning is 10. I paid 7 times of the EPS. That means price earning multiple comes 7 times. Similarly, whenever they acquire a company, you go back home and try to check any ratio. Try to check when deal happens, what is EBITDA multiple? EBITDA multiple tells you that whether I am acquiring a cheaper or expensive company. Second important part, many of you said, was we compare the neighborhoods. For example, when we compare the neighborhoods, I want to see at what multiple the companies are trading at. For example, the company is trading at 7 times EBITDA multiple, 6 times EBITDA multiple, and I want to acquire them. I know I should not pay more than 7 times on the higher side. I know they will not accept my offer lower than the 6 times. That is called EBITDA. EBITDA is the most used term because it is not impacted by cash depreciation amortization. Anyone who is looking at EBITDA, if that number is justified or good enough, they'll say company is doing very well. Because any kind of companies which are in expansion mode, especially the sectors, for example, if I speak about telecom sector or any kind of infra sector or the shipbuildings, for example, if they are in these sectors, the capital expenditure capex would be very, very heavy. Once your capital expenditure is heavy, automatically depreciation would be very heavy, which will be amortized or depreciated over a long period of a time. So your income would get distorted definitely. I was telling you yesterday, for example, that HFCL News, when they have something industry set up, they'll have some setup, they'll have some capital expenditure, then depreciation would come. Their net income would take the impact. But more or less, are they able to add to the top line, and are they able to get benefit at the EBITDA level? That would be seen by the experts. The moment your EBITDA is good enough or positive, you'll be very satisfied. If you go back home today, especially check idea only. Check the idea net income level. I think they earn 10,000 crore. Maybe the loss is around 7,500 or 8,000 crore. And then check their EBITDA level. That could be one of the best examples. Idea I love only I tell you why. Because don't take it otherwise. This number, idea, I track that very aggressively. That company will survive or not. Number will survive or not. I'm using this number for 20 years now, more than 20. And those who have been taking classes for me, first day itself I start talking. I love that number, not for investment purpose, whether this 9891165923, this number belongs to me. This will survive or not. Yesterday when I started the class, not yours, before that there was a class, price was 15 rupees 10 paisa. Then class ended. Then today market opened. Price was 18 rupees 40 paisa. For you, 15 is becoming 1840, that. But it was how much return? And for me it was safeguard. My number will survive, maybe. I'll discuss with you at the end of the class. Something has happened in that. That number came just now because anyhow idea I speak a lot. That I speak a lot, not this batch, every batch I talk. And there's certain reason of it. I track it for because I keep it on line. A number will survive, idea will survive. Tuesday is important day. The heartbeat will be like this. What happens to the board meeting on Tuesday? Anyhow, come back. Let's not become emotional about idea. What we were discussing? EBITDA. Short-term memory. EBITDA. When you go back today, I would expect some of you, I told you, even if it's exam time, please spend 5-10 minutes of your precious time on reading that paper. Now you can spend 5-10 minutes. When you get more time, read aggressively. Why I tell you is, you think that after becoming CA, market is open for you. Companies are waiting. Oh, chartered accountants are coming. They expect that degree, but that degree will only make you sit in front of their table. They might not ask you anything from that course content. They'll ask everything what is happening around the globe. Anything you know, smartly answer, because they are not hiring you because of you, they are hiring someone who can represent their company. Because over the period when we take, anyhow, when interviewer takes an interview, he knows that I am hiring someone who knows what is happening around. So he can talk, he can justify, and hence I tell you, the more you'll read, the more you will be able to interpret. That's it. Nothing important. These terms your institute has started using, but in a very general way or not that aggressively. EBITDA is a proxy cash flow, and you should know that if any company is reporting a very good EBITDA level, or if by chance EBITDA comes higher, even though there is a net loss, still that company could be respected. Especially the startups I'm talking about, because a lot of startups are gaining, and you know they burn cash. The net incomes are huge losses. If you find a lot of IPOs which have come of these startups, they are into the problem. But their valuation was in more than 1 lakh crore. The market cap went up more than 1 lakh crore, which was even higher than some of the nifty companies. You cannot imagine the kind of respect they get only because of this number which comes. For me, this number is a valuation multiple. This number would be used when the IPO comes in. For example, if I'm a private company and my IPO has to come, then I'll be using this number. I'll do some exercises so that you can do some calculation for the IPO valuation also. The EBITDA is considered as a proxy cash flow because it is not impacted by DNA. When you're doing a valuation, important parameters, abnormal items should be ignored. Abnormal are anything which is one time in nature. Any loss has happened and heavy loss has happened, and your numbers have drastically gone down net income. It is not necessary that your share price will take a hit, because market knows this loss is only one time which has happened. Or if there is any abnormal gain, let's suppose by you are not a property dealer, or the company is not into properties, and there was a gain on sale of properties which came out, or there was gain on sale of some investments which came out, the numbers would not be taken for the purpose of valuation. That means when you are calculating this PAT level would be adjusted for any kind of abnormality. Abnormal incomes will reduce, abnormal expenses will add back. Then the a very important term which recently your institute in the study material have started using, means they were using that term but vaguely. Now I can see one or few examples, small examples on the same. Enterprise value. EV stands for theoretical takeover price of a company. Enterprise value is the very important term which is used practically. That's a theoretical takeover price of a company, and that is nothing but market cap plus debt minus cash and cash equivalents. If I try to draw my balance sheet, the equity stands here, that's a market cap, debt stands here, cash and cash equivalent stands here. And how the EV comes in and why it is called theoretical takeover price of a company: when you make a payment for them and you take care of the cash, means cash will come to you, actually you paid for rest of the assets or rest of the business. That's basically you are paying. EV is a very important term. It's a theoretical takeover price of a company. When I say Tata acquired Chorus at 7 times EBITDA multiple, or maybe some companies acquiring something at a 9 time EBITDA multiple, we are talking about EBITDA into 9 is nothing but that's EV, enterprise value, which comes out. And there are ratios which are used sometimes is EV EBITDA, EV by sales, EV by EBIT. These are the ratios which are practically used. Using this ratio I can do what is, for example, there is a unlisted company which want to come out for the IPO. Now I am unlisted company, I do not have share price, but rest, income statement, balance sheet, everything is available for me. I am in a telecom sector and there are some peer groups which are listed in telecom sector. What we'll do is, since the peer groups are listed, they will have the share price. Using that share price, I'll calculate the market cap of those comparable companies. Since those companies are listed, I will have a debt of those companies. Since those companies are having balance sheet, I'll have a cash and cash equivalents. I'll be able to calculate EV. Using EV and EBITDA of the comparable companies, I'll calculate EV EBITDA multiple. Let's suppose it came 8 times. Now what I'll assume is, if I was also listed, my EV by EBITDA multiple would have been 8 times. Since I have my income statement, EBITDA I know, I multiply EBITDA into 8, I'll get theoretical EV. Using EV, and then I know my debt, I know my cash and cash equivalents, I can reverse calculate my market cap. Using that market cap, how many shares my banker advised me to issue, divide by those shares, I'll get my share price. That is how the valuation is done. This is a very important parameter, and some of you, if you get time, and new IPO is coming, since a lot of IPOs are coming nowadays also, just open up the prospectus and then try to see basis of pricing. They'll tell you that how the pricing of the share has happened. They'll mention the mechanism. It could be one of the relative valuation. This valuation is called relative valuation, in which what we are doing is, we are looking at the comparable company, their multiple, assuming their multiple is my multiple, and then I'm reverse calculating my numbers. That's how the EBITDA is used. Now coming to few examples which I have taken so that you are comfortable on the EBITDA multiple. The next slide. Calculate EV from the following data. If share price is 100, share outstanding 2 lakh, debt 50 lakh, cash and cash equivalent 20 lakh, EV would be market cap plus net debt. Market cap is nothing but share price into shares outstanding. Net debt would be equal to debt minus cash and cash equivalent. Net debt is also very important term. The 30 lakh, so my EV would be 200 lakh plus 30 lakh, 230. Then I have calculate EBITDA multiple. EBITDA multiple is the EV by EBITDA. If this company, if the EBITDA of this company is 20 lakh, enterprise value is 230 lakh, EBITDA is how much? 20 lakh. So my EBITDA multiple would be 11.5 times. Now let's suppose I am doing valuation of an unlisted company whose EBITDA I know. I can reverse calculate what would be the EV of that company. If I know the net debt of that company, adjust for net debt, you will get the market cap. Market cap is nothing but equity price into the share outstanding, and then divide by the number of shares, you will get the share price. Example 3 is from the perspective of as if we are doing valuation of a IPO. Calculate the share price of a similar company if EBITDA of this company is 10 lakh and net debt of this company is 15 lakh if number of shares are 2 lakh. Now I say if I was also listed, my EBITDA multiple would have been 11.5. Then I can apply EV EBITDA is equal to 11.5. I can reverse calculate what? enterprise value. My enterprise value would be 115 lakh. EV is nothing but market cap plus net debt. So I can reverse calculate what should have been my market cap, 100 lakh. 100 lakh divided by the number of shares I have, my price should be around 50 rupees. This valuation is generally done when you do it. Especially EBITDA multiple is useful to know at what rates the companies are trading at. So if anyone, those who are experts in the industry of 10, 15, 20 years of experience, they can prima facie know that if this is the EBITDA level, we can acquire this company and we will be able to break even in how many years time. So depending on your Indian markets or European market, US market, they would know that the same sectors trade at what EBITDA multiple at what respective times. Because EBITDA is not impacted by depreciation, hence it's a very, very important number which comes. The question which your institute has asked in the exam is, read that question. Eight question. Read quickly once. I'll read out with you. Question number 8 we are on. Says T Limited and E Limited are in the same industry. Former is in the negotiation for acquisition of the latter. T wants to acquire the E. Important information about the two companies as per their latest financial statement is given below. So we have a T Limited, E Limited. Is 10 equity share outstanding, 12 lakh, 6 lakh. 10% debentures, 580, 12.5, 240. EBITDA. Now I don't know how they create these kind of terms. It's EBITDA. They write also earning before interest, depreciation and tax. It's actually, you write in the exam EBITDA only. It's EBITDA. Do not use this word. Laughable material. Market price 220. Now T is planning to offer a price for E Limited. Business as a whole. Business as a whole means EV. 7 times EBITDA reduced by the outstanding debt to be discharged by own share at market price. If you try to read this line, it is nothing but purchase consideration. T Limited says, I'll pay you 7 times your EBITDA. That means the EBITDA of this company is what? 115 into. You multiply by 7, you'll get EV. How much you get? 809.97 minus reduced by what? Reduced by debt 240. This is nothing but purchase consideration 569.97, and they'll issue shares at what price, sir? Market price. Divide by the market price divide by the market price 2.59 shares. So this is what he's talking about. Now E says E is also submitting its proposal. E Limited is planning to seek 1 share in T for every 2 shares in E based on the market price. He says, let's keep the life simple. My price 110, your price 220. So 2 shares of your is equal to 1 share of mine, and we'll have what swap ratio? 1:2. So that's a straightforward. Tax rate for 2 companies may be assumed as 30%. Calculate and show the following under both the alternatives: T's offer and E's plan. So first 4 points will do under different, that consideration, number of shares, EPS, expected market price. Fifth point I'll do together. In fifth point, my notes might have n number of advantages, but in exam, if you have to write the advantages only with respect to this, which I'll tell you what has to be written, because I have taken that as a combined answer, as if what is the purpose of acquisitions basically, and we'll do together. Now let's verbally do it, please. Let's look at the T. T already you told me net consideration payable came 569.97. Number of share also you calculated 2.59. Now for the purpose of new EPS, you'll have to calculate what? Combined earnings. Since you are good at calculations, you can do for me EBITDA. You are standing at 400 minus what? Interest. T only let's do it. E I'll leave it to you. T we do it 580 into 10, 58. So 400.86 minus 58. I'll get what? EBT. How much? 342.86. Minus tax and directly tell me Pat. 240. This is for T. E also, sir. E income level is what? EBITDA level is 115.71. Then you have a 240 into what? 12.5. How much do we get? 30. 3030. Then 85.71. Pat. Combined earning would be 300. And then total share outstanding were 12 lakh plus what? Point 20.56. New EPS 20. I hope you can calculate the combined earnings and then divide by total share outstanding. Then he's asking expected market price, means you'll multiply EPS into P ratio. Sir, P ratio we need to calculate. P ratio of acquirer T, 240 is this. EPS of this company would be equal to 240 divided by what? How many shares? 12 lakhs. How much EPS? Old? 20. Price of this company is 20. P ratio of this company would be 11. So you multiply into 11, you will get new price. Do the same exercise for E also, please. Do the same exercise for the E. What I have done is only under T's offer. In the case of E's plan, you don't have to reverse calculate income statement because that is already done. Try that out, please. Done. E said 1:2, so that was much simpler. Try that E1, please. E's plan was 1:2 swap ratio. So we have E's plan. Net consideration payable 1:2. New shares to be issued are 3 lakh. Consideration would be equal to 3 lakh into what is the price? 220. 660. Number of shares to be issued 6 lakh into half, 3 lakh. New EPS, already you have combined earnings, so 20 rupees and multiply by P ratio you will get. Now advantages, these are not the entire advantages of this question particularly. In this question you write, it's basically when T is acquiring E, it would be competition would be avoided, maybe increase in the market share, maybe economies of scale. So since they are in the same industry, access to new technology, that's up to you. Basically, these three are advantages which might not justify for this particular question. But I have taken it for example, uh, when two airline companies combine, they want to avoid the competition. We're not talking about the Competition Act at all, please. It's basically they want to avoid competition. When Vodafone acquired Idea or when they merged together, it was objective of these was they can avoid the competition at least amongst themselves. Increase in the market share, they increased, but over the period that has been decreasing because of the problem with the debt they have, which is bookish debt, I should say. Actually, the actual debt is very less. Economies of scale, cost reduction can come when you have some advantages of the deal. Getting access to new technology, for example, Tata's when they acquired Jaguar Land Rover, they went outside, would have been a very different kind of technology they would have taken out here. Entry into the new market, Tata acquiring a Chorus or Hindalco acquiring a Novelis, or when you acquire some different market, when you go, for example, the Bharti is have done some acquisition in the African countries, for example, or have telecom operations there. So you have a different markets in which it could be there. Diversification of business you find mostly with the big houses in India. One of the names which is very prominent, Adani, comes out. Find it's Adani Green, Adani Wilmar, Adani Energy. You can create a portfolio exactly. So that's a diversification. The objective is because you don't want to be in single business, and Reliance is master of it. If you look at the history of Reliance, they have been keep changing their businesses almost every 10 years. They read out what is the next, they move out. What they started, maybe the textiles, maybe the oil and gas, etc., and slowly into the, because actually what happens when you get so huge, your objective is to get ROI or return on equity. That's basically because you're not looking at abnormal profits. Telecom is one of these sectors, no matter what happens, someone will go and someone new will come. So telecom is something which will keep running, and if you are able to justify the income from there, that means in the huge amount which you invested, you are getting 10-12% return. That's it, justified return which comes out. So, and now they are retail, for example, Geo Financials, for example. So the n number of things they're doing, and AI also. I was reading some time back, couple of days back or yesterday, will come into that also. So they read out this is a basic quality of an entrepreneur or a businessman, that he looks what could be the next game changer in the 10 to 20 years time, and accordingly move into it. That's entering diversification of business. Tax benefit generally comes when a loss making company acquiring a profit making, that's only from the accountancy point, but very rare this is the reason. The main objective is basically if I am not able to grow organically, that means my business is not able to grow, I have to have inorganic growth, then I'll go for the acquisition. Go back home and also read out the M&A deals fail at least maybe 50-60% time. Still M&A is considered as one of the best world for any kind of a valuer, because that gives a huge uh, amount or a remuneration perspective. This is in this question, write only maybe 2 or 3 above 1, rest are only for the general purpose which I. This was the EBITDA based question. We'll do couple of questions which are off track in nature. Couple of questions which are off track in nature before we move to the valuation of this chapter. First off track question I'll cover is question number 25. This question also came in November 13. November 13. That means actually first time when you read, every time this question will change. I took in this chapter because the word came Tiger Limited wants to acquire Leopard Limited. Acquire word came, so I have kept this in this chapter. Tiger Limited wants to acquire Leopard Limited. Read out once quickly. First off track question I am covering. This is a general question. Valuation will start tomorrow only. Tiger Limited wants to acquire Leopard Limited. If you want to do your research, you can go back home and find out tiger, leopard, lion, how many varieties are there, how do they look. I've been trying my level best, but it's difficult to bifurcate. Tiger acquiring a leopard. Liabilities, assets are available of which company? Leopard. Information now, first point. Shareholders of Leopard Limited will get 1 share in Tiger Limited for every 2 shares. External liabilities are expected to be settled at 5 lakh. Shares of Tiger Limited would be issued at its current price of 15 per share. Debenture holders will get 13% convertible debenture in the purchasing company for the amount. Debtors and inventories are expected to realize which chapter feeling? External reconstruction. Actually, after doing so much of CA, you become feelingless. Feeling is very important. For example, idea phone I use, feeling is so important, I keep track of it day in, day out. I do not sleep without knowing that what is happening in that company. Winding up? We are not winding up. Nalayak, winding up. Which chapter? I think your course has totally changed. Amalgamation was chapter there somewhere. Or internal reconstruction. In some chapter you can recognize that this was, you pay this, you pay this. This was not actually internal reconstruction feeling. Wait. Now you tell me this chapter is this now. First. Just read question number, will not do. Just read question number 51 and then tell me which chapter is this. 51. 51 is also internal reconstruction. I think is internal reconstruction. I don't know. I am not good at accountancy. When I was studying, I was very good. I used to teach for a long time as a child. This is basically write off these expenses. This is internal. This question number 25. I don't know. Amalgamation. This topic now, amalgamation. My time it used to be accounting standard 14. Actually, I could not speak to you much on this chapter. Whether you say AS 14, now I don't know what accounting standard you have, or parent subsidiary, or associate relation, or affiliate. Valuation is a valuation. Actually, when you when you open up the newspapers, they'll sometimes say, actually the languages in the papers are, the value of this startup has become 1 lakh crore, even though acquisition is done only for 0.5% stake. You know what they do? For 0.5% they see how much he has paid and then they convert in what? 100%. So whether it is an affiliate, whether it's an associate more than 20 to 50, whether it is more than 50, or whether it's a combined amalgamation, from the M&A or valuation perspective, we do exactly the same thing. Valuation principles remain same. In accountancy, you show it separately maybe. Maybe you show it separately. Parent, what you do is, for example, Tata Chorus are two companies. So Tata reports its own number, Chorus own number. Then since Tata is a parent, they at the end they consolidate. Otherwise, when they acquired, the principle of valuation was same. Similarly, there could be some company in which I am acquiring less than 50% stake. My way of showing in the accountancy could be different, but when I am acquiring the stake, the valuation would be same. So this what you are doing, question number 25, I think first paragraph resembles maybe amalgamation, or depending on what you would have done. So he'll give you something. Second paragraph. Tiger Limited has decided to operate the business of Leopard as a separate division. The division is likely to give cash flows after tax to the extent of 5 lakh per year for 6 years. Tiger Limited has planned that after 6 years, this division will be demerged and disposed of for 2 lakh. No feeling. Feelings are very important. Chapter, which chapter? Capital budgeting. Acquire a business, run for 6 years, 6 years salvage value, wind up. The cost of capital 16. Make a report to the board advising about financial feasibility of the acquisition. Since word was acquisition, I have taken in M&A or valuation. Otherwise, this should have been part of capital budgeting. I'll prove it. It's a capital budgeting. Let's do it verbally, please. It's actually a capital budgeting. What do you do in the capital budgeting, by the way? When you calculate the NPV, you calculate PV of a cash inflow minus present value of cash outflow. That present value of cash outflow is nothing but he gives you initial outflow. Na? So first paragraph will help me in that initial outflow only. Initial outflow. How, sir? Look up. He says, how many shares he'll give for the first one? Half, na? So if I do my calculation, I'll roughly write the number here. 70,000 into half, and what is the price? 15. So I'm writing it here. Equity will, how much will have? 5,25,000. Now retained earning would be taken care here only. Debentures would be settled at what? Same 5 lakh, na? Debentures would be settled at rate of interest is changing. That's fine. And then external liabilities are creditors. They will be settled at what? 5 lakh they gave somewhere. 5 lakh. This is representing what side? Liability. So liability, they are settling equity at this, debenture at this, and this at this. And then they said debtors and inventories. Debtors and inventories would realize how much? Debtors plus inventories will give me 2 lakhs. And cash will give me same value, 50. Now look up please. When you say we are acquiring, actually you have never spent a time on the thinking that when you acquire a company, always find out liability addition first. Why are you paying for the liabilities? You are actually not paying for the, whenever you paid, now you have seen, you pay for the equity holders, you pay to the debenture holders, and you're very happy, oh, we have done the purchase consideration and we have done the acquisitions. You're doing only accounting entry. You're doing accounting entry. This is a mode of payment. Evaluation, you'll learn tomorrow how exactly valuation is being done. In this case, what is happening? The 5,25,000, 5 lakh, and this is the payment of a liability. And when you acquire liability, automatically you get the rights of the assets. The assets, two assets will give you how much? 250. So liabilities total minus 250. How much balance left? Liabilities total 525 plus 5 lakh plus 5 lakh minus 2 lakh and 50,000. 12 lakh, 10 lakh, 70, 12 lakh. From 0, 3 lakh I'll put. Debenture is 3 lakhs. Our debenture is 3 lakh only. Total is this. How much is total? 13 lakh 25. With that I get a right of what? 2 lakh 50. 10 lakh. Actually that 10 lakh 75 in this question I'll write cost of acquisition, because I'm writing CA final paper. Otherwise I am buying this plant and machinery for 10 lakh 75,000. If you try to analyze double entry system, you've paid all liabilities, acquired the asset. So from liabilities you minus the asset, these two. The balance is whose price? Plant and machinery. So if he would have said this question, plant and machinery 10 lakh 75, calculate the NPV, everyone can do. But he has created in the language form. I hope you're getting my point. Then what this is basically 10 lakh 75, whatever will come is nothing but cost of acquisition of that plant and machinery. Then he says we'll run the business for how many years? 6 years. CFAT 5 year. If you have a same stream of cash flows, you can apply what? Annuity. That means instead of multiplying with each year factor, you can add up all the factors. You can add up all the factors and multiply with the 5 lakh. How do we calculate, sir, PV of a cash inflow? PV of a cash inflow is nothing but its present value of CFAT into present value annuity factor plus 2 lakh is what, my salvage value or terminal value. Terminal value into what factor? Last year factor. That will give me PV of a cash inflow minus outflow would be equal to 10 lakh 75,000. Calculate the value. You can do me a favor. You can add up all the numbers. 3.684. 5 lakh into 3.684, 18 lakh, 18 lakh 46,000 complete. And then terminal value or salvage value into last year factor, 82, only 82. This is called PV of cash inflow. 19 lakh 24,000 minus the 10 lakh 75 outflow. Basically we are doing nothing. If you try to analyze what has been done here, is it is nothing but it's a present value of cash inflow minus the outflow. In general sense, he gives you the data. In this, he has asked or applied the application, can you make out that cost of acquisition? Hence, the answer you can go back. If by chance some of you are not having this slide, you can go back in this video under the link, the slide should be available. Number what? 25, na? When at the extreme end. Yes. 34th slide. 34th slide I am on. Cost of acquisition rupees 5,25,000. Settlement of external liabilities, issue of 13% debenture 1325. Realization of debtors inventories, cash balance, cost of acquisition 1075. This is I write as a cost of acquisition, but actually this is what he paid for plant and machinery, or value of the plant and machinery. And then what happens is 1075 comes, then NPV calculation, PV of cash inflow minus outflow. PV of a cash inflow will be annual CFAT into annuity factor, salvage value into the present value factor. We get PV of cash inflow minus outflow. Since NPV is positive, we write, since NPV is positive, it is advisable for Tiger Limited to acquire Preferred Limited. This actually should have been a capital budgeting question. This was one off-track question. Another question which came in the exam. First time when it came, it was difficult to know which chapter it was. Again, the merger word came, and we had put in this chapter only. Number 49. That's off-track question. Number 4949. If you want to do the calculations, take the calculation. Now, let me look at question number 49. It says Simple and Dimple Limited are planning to merge. The total value of the companies is dependent on the fluctuating business conditions. Now, when we say fluctuating business condition, that means market values will fluctuate. The following information is given for the total value of debt and equity structure of each of the two companies. Business condition, probability, Simple Limited and Dimple Limited. Probability, this basically this 820 Simple Limited I am talking about. 820, 550, 410 includes debt and equity both. It says current debt of Dimple is 65, Simple is 460. Calculate the expected value. Calculate the expected value of debt equity. The word is important separately. If that word was not there, it would not be a challenge and we would make a mistake. Since he says basically what he wants is from the combined value, segregate the value of equity debt, segregate the value of equity debt, segregate the value of equity debt, and then calculate probable equity value of Dimple, probable debt value of the Dimple. Similarly do for the Simple, and that add probable values. How do we calculate probability, sir? For example, look up please once. In the Dimple Limited, how much is the debt? 65. So out of 150, if I subdivide the value equity and debt, how much do we get? How much do we get? 985 and 65. So everywhere I'll get 65, and then I can get what? My equity values. Now what I can do is we multiply 0.2 into equity, 0.6 into equity, 0.2 into equity, we get probable equity value. Similarly, we can calculate debt since debt is remaining 65, so there is no challenge. Now Simple Limited, help me out please. Simple Limited, help me out. You have how much? 460. 820 minus debt is 460. How much do we get? 360. Second case, 90 and 360. Third case, and my objective is this value is equity plus debt. If you subtract 460, you get equity value 360. Out of 550, 460 is debt, equity value would be 90. 410 equity 0. Debt value 65. 4. Since equity value cannot be negative, you have to make sure your debt would not exceed what? 410. This was the only problem. Actually, this question was weirdly set. They can set anything. Onus is on you to do the answer in the exams. If the reason of asking separately was so that you know, in this question, if you look at the answer, please look up please once. These are off track questions, and these questions have no straightforward answers. You'll have to accordingly do in the exam. Dimple Limited, business condition, high growth, medium growth, slow growth, total value, debt and equity subdivided, no challenge came. In the business condition, you have simple limited, total value, debt value, equity value. Third case, if you write here 460, your equity value would be negative. Negative equity value means share price negative. That's not possible. Equity value of the company cannot be negative. I'm not saying book value, it's equity value, market value cannot be negative. Hence the debt value in the simple limited and under slow growth would be capped at what? 410. So this is basically, you know that there is a 460 debt, but it has to be capped to what? 410. And when you calculate the expected value of debt and equity, look up please. When you calculate the expected value of debt and equity, 65 into the respective probability, answer will come 65 only. Equity value into the prospective probability, 758. Similarly, debt value into the prospective what? Probability, and equity value into the prospective probability. And then we can add up debt and debt, equity and equity. Quickly check the answer. Not for quickly. It's basically, since equity value cannot be negative, hence debt has to be capped. Done. The first question is your internal reconstruction. I have given the answer, you can do at home. Basically they subdivide 10 rupees face value share into 2 rupees, then preference shares are reduced to 5 rupees fully paid up, and ultimately I think 51st objective would be to write off these expenses. I would have given the answer is available on slide 33. You can do once because twice it has been asked in the exam. Chapter is M&A and restructuring, I think. Business valuation separately. So accordingly in restructuring, they can ask you. So reduction of the liabilities, equity share, preference share, waiver of the debenture interest, this, and then land and building, and then amount available is this. With that amount available, you do some revaluation. Exactly same thing. When you go back, it will remind you of your interest. This is exam question only. And recently also this. Try it out, please. Do not leave it in the hope that we remember it. At least one or two you try out so that you know. Actually, he'll write off, I think, utilization, write off preliminary. These are debit balances given. 51 you can go back home and do. Not spend time here. Done. We can wind up here. Wind up here. Yes. Take care and bye bye. Come back again now. 51st is your homework. Tomorrow can we start around 4 o'clock? Let's start around 3 tomorrow. 3 o'clock. Let's keep 3:15. I have a class before that. 5 hours, 6, 11. I have to survive also for a week time. Now coming to the schedule. We have covered mutual fund, security valuation. M&A I hopefully will finish tomorrow and we'll move to the bond valuation. Till tomorrow I know. Actually, when you work in the financial world, you don't know what will happen after 1 minute. Practically speaking, even I don't know what will happen if you ask me, because for your batch I'm staying back, else I keep, the moment batches are over, I keep traveling. I know one thing for sure, we'll finish off, I think, M&A, most probably even if I stretch it out by tomorrow, we'll enter into the bond valuation hopefully. Sunday we'll finish off that also. Then Forex or derivatives, I'll take the call accordingly, we'll pick it up. Then Forex, because Forex derivative has to go combo. Anything can be done. Not Monday, Sunday only it will come if we are meeting Sunday. Cannot tell you, depending on circumstances. Sunday we are meeting, that Sunday could be for any, after bond valuation it's Forex or derivatives. Then it's a currency derivatives. Then portfolio, capital budgeting, then smaller chapter. So my focus was exam, then would be a combo. The important conceptual chapters are derivative Forex. So I'll cover up the questions number wise appropriately, don't worry. I'll cover up the slides slightly faster I would be. In this it's a slightly speed is also faster. Forex it can happen that initially I'll take my own time to make a base work, and then once you get comfortable, since solutions would be there with you, it will not take me a time to do it. So timing, just leave it to me. Timing I cannot tell you, only one timing. So tomorrow for example, holiday we can start this way. Market time, because I have to keep track of this company. I'm telling you, no, if this gets wind up, you will not get the feel. It will give you the feeling. Wait for a minute now. Actually, you cannot get that feeling. You've done derivatives. You'll do derivative. I'll show you in a day. You've done option futures? I don't do. I keep track of idea from the perspective that whether it will wind up or not, numbers will sustain or not. And I am yet to do a recharge also. After Tuesday only I'll do it. Now this might look to you only 7.8 percentage. This might look to you. Since you'll be doing a lot of derivatives, I'll show you that time also one screen. If I think, let me see if I have that screen, because that's part of your course. It's not that I have to show something because I want to show. Which chapter? Derivatives. Just give me a second's time, please. Idea. I have to give it for you. I don't know where. Anyhow, today only I can show you that from this part. Wait. What is idea? Na? Idea. This is something I quit for my education purpose. Derivatives. Part of your course. Let me show you something. You'll be studying when we do derivatives something called call and put option. Strike price is 18. It's a call option. Click here. Something opens up. This call option 18. Open price was what? 25 paisa. Went high as 110. The lot size is 80,000. Lot size is 80,000. I was trying to find what screen I saved for some batches when I take a class. I save for them. In a single day, a 10 paisa item can become a 1 rupee. That's how many times? 10 times. Share price does not increase 10 times. FNO is dangerous because of that. Holders might make a money here, writers close out and they never enter this market again. So this, you can imagine, a 20, yesterday it was 20 paisa, went up to 110. That's almost 5 times. 80,000 lot size. And Tuesday would be very critical for it. If something drastic positive comes, no matter what happens on Tuesday, if either the movement would be highly upside or downside. Since we'll be around that chapter only, if time permits, I'll show you, because this is such a dangerous market which comes out. Percentage wise, if you look at, the actually last closed was 75 because the price has fallen. Otherwise, sometime we have this price as 1000%, this price as 200%, and that happens only with the FNO, which is an option. 80,000 lot size you have. So the dangerous market is there. For educational purpose, I have to keep track of it for my survival of idea or not. Hence, weekdays will start slightly later. Weekends, for example, tomorrow will start at around 3. Start around. Take care and bye bye.